Hey folks, welcome to another video by Stocktrades. My name is Matt, and today we are going to be taking a look at a couple of pipelines. Our subscribers have been making a lot of comments and asking us quite a bit about pipelines, so we figured let's do a little bit of a video and let's talk about a couple of pipelines that don't get perhaps as much coverage as they should. And we'll do that right after this. Before we jump into the two pipelines we're going to look at today, just a reminder to smash that subscribe button. We are upping the frequency of our videos, trying to put out videos at least a few times a week. And, last year we were successful in releasing one video a week. This year we're really trying to bring more Canadian content to investors. So be sure to smash that subscribe button so you don't miss out on any great Canadian content. And with that, let's get to our first pipeline that we're going to talk about today, and that is Inter Pipeline. So why is there a big interest in midstream companies and pipelines in particular? Quite frankly, it's because they are some of the most reliable income stocks on the TSX index. Typically, their dividend is covered by stable and reliable cash flows, and their bottom line isn't as impacted by the high fluctuating price of oil. They tend to be a little bit more insulated than the major energy producers. However, there are times when the dividend could be at risk. And that's because the companies perhaps are taking on too much debt, they have big capital projects, and cash flows are being impacted. And a perfect example of this is Inter Pipeline. So Inter is undertaking the largest project in its history, the Heartland Petrochemical Complex. It's a first of its kind in Canada. Now, although the company was delivering the project on time and on budget, it had little wiggle room in order to sustain that dividend. Prior to announcing its dividend cut this past spring, the company had planned on the sale of non-core assets and forecasted cash flows to carry it through fiscal 2020. Unfortunately, the sale of these assets were delayed and the pandemic hit, which impacted cash flows. The costs at Heartland were ballooning and were revised upwards to $4 billion from the previous $3.5 billion. That represented a 16.67% increase. So as the pandemic raged, Inter Pipeline, they really had no choice, and they announced a 72% slash to that dividend. Anyone buying into the company for the income when it was yielding north of 15% was taking on considerable risk. It simply wasn't sustainable. And the most disappointing aspect of all this, Inter Pipeline was a Canadian dividend aristocrat and all-star. It actually had an 11-year dividend growth streak. And with the cut, that streak is effectively at an end. So where do investors go from here? If it's not a reliable dividend growth stock, what is it? Well, for starters, Inter Pipeline is still expected to reap significant benefits from Heartland. As of the end of the third quarter, the project is about 72% complete, and the projected CapEx in fiscal 2021 is expected to be approximately $800 million. Now, this is still a pretty significant cash outlay for a smaller cap pipeline. It's therefore not surprising that the company is, in its own words, exploring partnership for material interest in Heartland. This would allow them to reduce future funding requirements and improve its financial ratios. Bottom line, the company remains in a stretched financial position. This doesn't bode well for any future dividend growth, at least in the short to medium term. In 2019, the company was the subject of takeover rumors as astute investors smelled blood in the water. Management and the board quickly rebuffed those attempts, and Inter Pipeline remained steadfast in its ability to deliver HPC on its own, on budget, and on time. Turns out, those potential acquirers were onto something. While Heartland is still a flagship project, it isn't expected to enter into operations until early 2022, a few months behind the original plan. The project is expected to be underpinned by approximately 70 to 85% long-term cost of service contracts. And once fully operational, Heartland is expected to generate $450 to $500 million in average EBITDA per year. That's a nice jump. To put this into perspective, Inter Pipeline is expected to exit 2020 with adjusted EBITDA of approximately $800 million, and that's at the high range. So there's no doubt that Heartland is a transformational project for the company, especially for one the size of Inter Pipeline. There is, however, a caveat to all this. If the company brings in a partner, which is looking increasingly likely, Heartland's contributions to Inter Pipeline's EBITDA will be impacted. To what extent? It's all going to depend on what kind of deal is struck. As of writing, Inter Pipeline is yielding approximately 3.5%, which is well below historical averages, but it is respectable. If, however, investors are looking for reliable and stable dividend growth, you might want to look elsewhere. there still remains plenty of uncertainty around Heartland, and until the complex is fully operational, that dividend is likely to remain stagnant. Personally, I own Inter Pipeline. At the moment, I'm in a wait and see mode. Not quite sure what I'm going to do with the stock quite yet. I didn't buy it for the dividend. I bought it because of Heartland and the potential growth. My concern, however, is that if it is looking to take on a partner, how much of that EBITDA will go to Inter and how much will be redirected to the new partner. So that's the uncertainty. It's still a good company. It just got perhaps a little bit over its head with a project the size of Heartland. Next up on our list, we are going to be talking about one of my favorites and another one I own, which is Pembina Pipeline. When investors talk about pipelines and the best in the country, they usually associate that with TC Energy and Enbridge. And rightfully so. They are the two largest pipelines in the country, and they have performed quite well. They have among the longest dividend growth streaks in the country and are simply really solid income plays for investors. However, I'm also going to make the argument that Pembina Pipeline deserves to be in the conversation with the best pipelines in the country. Pembina has a market cap north of 16 billion, and it is one of the largest midstream companies on the TSX index. Over the past year, the company has underperformed its peers and has lost approximately 30% of its value. This is in stark contrast to the company's strong history. Pembina is the second best performing pipeline over the past handful of years, and with returns of 65%, it is tops among all TSX listed pipelines over the past decade. So is the recent underperformance an opportunity for investors? I believe so. For starters, let's look at the company's financial position, which is, once again, among the best in the industry. The company has a current ratio and a quick ratio of 0.71 and 0.54 respectively, both of which are second only to Keyera. As they operate in a high capital expenditure industry, pipelines tend to carry high debt loads. This is normal. However, there could come to a point where debt load becomes an issue. We talked about this and referenced how that impacted Inter Pipeline and how Heartland impacted the company's cash flows and subsequently led to a dividend cut. In Pembina's case, the debt load is quite manageable. It has a long-term debt to equity ratio of only 68 and a total debt to equity ratio of 70.44. Worth noting, these are best in class, and Pembina is the only TSX listed pipeline with a debt to equity ratio below 100. We've talked about Inter's Heartland issues and how increased costs ultimately set the company back. So executing on big projects on time and on budget is of the utmost importance in the industry. So how has Pembina done? Once again, Pembina comes out looking really good. The company has an impeccable track record of delivering on time and on budget. It's actually one of the best in the industry. Looking forward, Pembina has a backlog of approximately 11 billion of capital projects in the pipeline. Pun intended. It does expect to place 1.1 billion of that into service by the first half of 2023. This will enable the company to continue growing cash flows for years to come. Cash flows that will support the dividend. Now, Pembina is also a Canadian dividend aristocrat. It owns a 9-year dividend growth streak. True, it's not as long as somebody like Enbridge or TC Energy, but there is no reason to expect the company won't continue raising that dividend. Over its growth streak, the company has managed to raise the dividends by mid to high single digits. The company has a respectable payout ratios against adjusted cash flows from operations and fee-based distributable cash flow of 60% and 72% respectively. Also worth noting, 95% and 72% of adjusted EBITDA stems from fee-based or take-or-pay contracts, so it's well covered by consistent cash flows. Pembina aims to pay out less than 100% of fee-based distributable cash flow, and in 2021, that guidance is forecasting a ratio of around 71 to 75%. It's also worth noting that the company's current cash flows are sufficient to cover the dividend, capital projects, and share repurchases. What does this mean? That means that Pembina's capital investment program is fully funded by cash flows. That means it's not going to need to tap the debt markets, nor will it need to tap the equity markets for additional cash. All things considered, Pembina is likely to extend its dividend growth streak to a decade this coming year. If you're looking for a reliable income stock and one that has a strong history of performance, Pembina deserves another look. Remember, this is a company that is the second best performing company over the past 5 years and has outperformed all TSX pipelines over the past decade. This is in spite of the fact that the company has underperformed this past year. This underperformance has likely presented investors with a buying opportunity. My opinion, Pembina Pipeline is one of the strongest pipelines in the country, and it's worth being in consideration among the best with Enbridge and TC Energy. And that brings us to the end of our video. We covered 2 pipelines today, not the usual. Inter Pipeline, which we think is still an interesting one to hold. It's not one I would go out and rush to buy right now. There's still a lot of uncertainty around Heartland, and that dividend cut really impacted investors. Don't count on it to raise that dividend until Heartland is fully operational. On the flip side, we have Pembina, which is among the best. It has a strong history of dividend growth. It is in one of the best financial positions of all the pipelines, and it will deliver consistent capital appreciation. We think it's one of the best. I own both, and I'd be curious to hear your comments about these 2 companies. Let us know if you own them. Let us know if you prefer Enbridge or TC Energy and why. And I'm particularly interested in hearing your thoughts on Inter Pipeline. Is this one that you're holding? Is this one that you think will return to dividend growth sooner than perhaps I'm expecting? Let us know in the comments. As always, please like the video and subscribe to our channel for more great Canadian content. Until next time.